Hello and welcome to the derivative session. I'm going to cover interest rate swaps in this session. We'll look at the nature, structure, risk and return of the product, along with its application to fund management. Interest rate swaps are bilateral agreements to swap a fixed rate for a floating rate of interest on a notional amount. Swaps trade over the counter, so can be tailored to specific needs. The fixed rate is based upon the swap rate, the cost of borrowing over a longer period of time for an institution of usually good credit quality. LIBOR quotes are available, but only out to 12 months. Swap rates represent the longer-term proportion of that curve. Swap rates are available to borrowers making an assumption of their credit risk. So a AA+ rated company requiring an interest rate swap will pay more or less the quoted swap rate. A company further down the credit spectrum may pay an additional amount taking into account their own risk. Either way, both sides will agree the fixed rate and also the floating rate, usually LIBOR. Always consider LIBOR rates are quoted as annual figures, so will need to be divided by the amount of payments over the year. Our example shows biannual payment and receipt. We always refer to swaps from the fixed leg perspective. So one would either pay fixed or receive fixed. So how are these useful to us? If we look at the fixed leg, we're receiving a fixed rate of half of the 2.145% interest every 6 months and paying a floating amount based upon 6-month LIBOR. If yields, or LIBOR, go up, we could end up paying out more than we gain. We would theoretically lose money on that payment. But consider a fixed rate bond. If yields rose, the bond would also lose value. So the interest rate swap is only as sensitive to changes in yield as the fixed rate bond would be. Thus, swaps are fixed income derivatives. They behave in the same way as the physical bond when yields change, and you will also see have a duration. This is a 5-year swap, and we would expect a duration of around 4.7 years, just like a 5-year fixed bond. See the bottom right corner of the screen. The DV01 is essentially the duration of this swap, but in monetary terms. It takes the duration times the notional times 1 basis point. So for each movement in yield, this swap will either make or lose $4,725. A fixed payer swap and receiving floating would be like selling away a bond, getting rid of duration. Consider the dynamics of a fixed rate bond that gains coupons from a fund. It could also use some of these coupons to pay fixed, thus receiving a floating amount in order to turn the fund into a floating rate vehicle. As yields increase, thus my floating amount received increases as the floating rate note. This can be used to reduce duration in a fund in whole or in part. The benefit of swaps are their flexibility to hedge risk over any notional amount or any time period. They do not require a huge outlay of cash, they're highly liquid, and they are as easy to value as a physical bond. Of course, we do take on counterparty risk when using swaps, which is a consideration.